October the 2nd changed everything. The spot price did something it hasn't done in decades. 4 straight years, 800 million ounces, gone. While Washington declared silver a strategic asset, China sealed its borders to exports. And the Federal Reserve's balance sheet still values gold at a price from 1971. But here's what almost no one is discussing: the physical metal. The actual bars in the vaults are disappearing faster than futures contracts can cover them. And when Treasury Secretary Bessent mentioned monetizing the asset side, he wasn't talking about selling bonds. He was talking about something far bigger, something that could revalue everything overnight. The question isn't whether precious metals will reach these targets. The question is, what happens to your currency when they do? Welcome to Currency Analyzer. Now, I realize you didn't stumble here by accident. If you've spent decades building something, if you understand that financial decisions require preparation, not panic, then you already know why channels like this matter. We'd be genuinely honored if you'd consider subscribing. Not because we're chasing numbers, but because economic literacy among experienced professionals has never been more critical than it is right now. And I'm curious, where are you watching this from today? Are you in North America, watching central bank policy unfold in real time? Europe, where currency dynamics are shifting beneath established systems? Asia, where the physical metal markets are actually setting prices now? Or perhaps somewhere else entirely? Drop your location in the comments, because what's happening in precious metals isn't just an American story anymore, it's global, and the professionals who understand that first will be the ones positioned correctly when the revaluation Hemke discussed actually occurs. On October 2nd, 2025, silver reached $48 per ounce. Most traders saw a number, a milestone, another entry in the price charts. Craig Hemke saw something entirely different, something that hadn't happened in over a decade. The spot price, the actual physical metal available for purchase that day, was trading higher than the futures contracts, higher than the March delivery promises, higher than the paper agreements. This is called backwardation. And in the silver market, it's not normal. Think about it this way. In any functioning market, a promise to deliver something later costs more than buying it today. Storage, insurance, time. These things have value, but when the spot price exceeds futures, something is broken. It means people need the actual metal now. And they're willing to pay extra to get it immediately, rather than wait for a contract to settle. October wasn't an isolated event. The backwardation deepened throughout the month, then eased, but never fully disappeared. Even during heavy selling in early January 2026, when silver dropped 5% overnight, the backwardation returned 30 to 40 cents. The spot price was consistently 30 to 40 cents higher than March futures. This pattern kept repeating. Hemke had been analyzing precious metals markets for 15 years. He'd seen silver spike to $50 twice before. In 1979 and 1980, silver rocketed from nowhere to $50 in about 4 months, then crashed back to $10 in just 2 months. In 2011, silver hit $48 on April 28th, then collapsed. It took over a decade to return to those levels. But 2025 was different. This time, silver didn't just spike and fall, it held, it consolidated, it pushed higher again. From $50 in early autumn to $60 to $70, briefly above $80. The moves were violent. $3 to $4 swings became normal daily behavior. Price ranges of 10% in a single session weren't unusual anymore. Exchanges raised margin requirements, forcing traders to deposit more cash just to hold positions. But the underlying trend continued upward, and the backwardation kept appearing during stress moments. This told Hemke something critical. The paper market, the futures contracts, the derivatives, the leverage was under pressure because the physical market was running short. For 4 consecutive years, the global silver market had been in deficit. Production from mines, plus recycling, hadn't been enough to meet demand. Demand from industry, demand from investment, demand from jewelry manufacturing. The total deficit over those 4 years, 800 million ounces. That's not a small number. That's roughly 1 full year of global mine production. Gone. Pulled from warehouses, withdrawn from exchange vaults, consumed by solar panels, electronics, medical devices, and investors who wanted to hold actual metal. The London silver lease rates started climbing. These rates measure how expensive it is to borrow physical silver for short periods. When lease rates rise, it means physical metal is tight. When they stay elevated, it means the tightness isn't temporary. Vault stocks at exchanges, the publicly reported inventories, were dropping. Not dramatically, not in a way that made headlines, but steadily, week after week, month after month. The metal was leaving. And here's what made this situation different from 1980 or 2011. In those previous spikes, price was driven by speculation, by futures traders piling into contracts, by leverage and momentum. When the speculative fever broke, the price collapsed because there was no physical shortage supporting it. But in 2025 and into 2026, the price wasn't being driven by paper speculation. It was being driven by physical demand colliding with physical supply constraints. Industrial users needed silver for manufacturing. Solar panel production was consuming record amounts. Electronics demand wasn't slowing, and investment demand from people buying coins and bars remained strong. Meanwhile, mine production wasn't growing fast enough to cover the gap. New mines take years to develop. Existing mines were already producing at capacity, and the easy deposits had been found decades ago. This created a structural problem. The silver market has operated on a fractional reserve system for decades. The pricing mechanism, centered in New York and London, relies on derivatives, futures contracts, options, paper claims on metal that often doesn't exist in allocated form. This works fine when there is enough physical metal in the system to satisfy the small percentage of contracts that actually demand delivery. But when the physical base starts shrinking, when 4 years of deficits pull 800 million ounces out of inventories, the leverage gets stretched, the fraction gets smaller, and the system comes under stress. That stress shows up as backwardation, it shows up in rising lease rates, it shows up in price volatility, and it shows up in something else Hemke noticed. When silver traded in Shanghai overnight and Chinese exchanges raised margins, the price would drop there first. Then London would open. And without Shanghai buyers in the market, London would see additional selling. By the time New York opened, silver would be down 5%. But it wasn't economic news driving this. It wasn't a change in fundamentals. It was mechanical. It was the physical market in one location affecting the paper market in another. This wasn't normal technical trading. This was the global physical supply chain showing cracks. And those cracks, Hemke believed, were only going to widen in 2026 because governments were about to make everything worse. Something shifted in Washington during the autumn of 2025. It wasn't announced with fanfare, no press conferences, no presidential speeches. But buried in a Federal Register notice, silver was quietly reclassified. No longer just a commodity, no longer simply an industrial metal traded on exchanges, silver became a strategic critical mineral. The same designation reserved for rare earth elements, for lithium, for materials considered essential to national security. Craig Hemke read that notice, and he understood immediately what it meant. The United States government was claiming ownership, not physical ownership, but strategic priority over domestic silver resources. This wasn't about market prices. This was about control. Across the Pacific, China was moving in parallel. October brought export restrictions, not a complete ban, but controlled quotas, licensing requirements, bureaucratic barriers that effectively limited how much silver could leave Chinese territory. And it wasn't just silver. Rare earth elements faced similar restrictions, certain grades of copper, materials used in advanced manufacturing, defense systems, technology infrastructure. Two of the world's largest economies were simultaneously ring-fencing their resource supplies. This doesn't happen by accident. This doesn't happen because of market concerns or trade imbalances. This happens when nations prepare for something larger. Hemke had watched geopolitical patterns long enough to recognize the signs. The United States wasn't just talking about adversaries anymore. The Trump administration was taking action. In early January 2026, an operation unfolded in Venezuela that stunned international observers. Over 160 aircraft, Delta Force operators, a coordinated military insertion into a sovereign nation. The objective wasn't regime change through proxies. It was direct. President Maduro was physically removed from Venezuelan territory and transported to the United States. Whether one agreed with the action or not, it demonstrated something important. Policy rhetoric had become operational reality. When Secretary of State Rubio stood before cameras that Saturday morning, his message was clear. This is a president of action. When he says he's going to do something, he means it. That statement applied to more than Venezuela. Trump had been discussing Greenland for years. Most analysts dismissed it as political theater, negotiating tactics, pressure on Denmark over NATO contributions. But then serious proposals started circulating. What if the United States offered every Greenland resident $1 million, 50,000 people? $50 billion? Too expensive? Offer $10 million each, $500 billion. Where would that money come from? Not from bond markets, not from tax revenue, from the Federal Reserve's balance sheet. Specifically, from an accounting mechanism that almost no one was paying attention to. The Fed's gold holdings are listed at $42.22 per ounce. That's the official price, set in 1971, when the Bretton Woods system collapsed. The actual market price in early 2026 was over $4,000 per ounce. This creates an enormous paper discrepancy. If the Treasury were to revalue that gold to current market prices, the difference becomes available capital, not through borrowing, not through money printing in the traditional sense, through balance sheet adjustment. Treasury Secretary Bessent had mentioned this publicly months earlier. Monetizing the asset side of the balance sheet, he called it. Most people ignored it. Hemke didn't. If gold were revalued to $10,000 per ounce, the accounting gain would exceed $2 trillion. $2 trillion that could fund a sovereign wealth fund, that could purchase strategic territories, that could finance infrastructure without issuing new debt. It sounded absurd. Until you remembered that sending special forces into Venezuela to extract a sitting president also sounded absurd. Until it happened. Meanwhile, the broader resource strategy was becoming clearer. Trump's drill baby drill rhetoric wasn't just about energy independence. The United States was already the world's largest crude oil producer. This was about stockpiling, about ensuring domestic access to materials that might be restricted in a prolonged economic or military confrontation. Uranium programs were being expanded. Rare earth element mining on federal lands was being fast-tracked. Copper production was being prioritized. And silver, with its unique properties in electronics, solar energy, medical applications, and industrial processes, was now on that list. China was doing the same thing from the opposite direction, restricting exports, building domestic reserves, ensuring that its manufacturing base had priority access to critical inputs. This wasn't Cold War ideology, this was supply chain warfare. And it was happening in real time. Hemke noted something else. Copper had reached $13,000 per ton in London, an all-time high. Copper is used in electrical wiring, construction, industrial machinery. It's not a speculative asset. When copper reaches record prices, it means physical demand is overwhelming available supply, and it means industrial users are worried about future availability. The same pattern was appearing across multiple commodities simultaneously, not because of inflation alone, not because of monetary policy alone, but because governments were actively removing supply from global markets. For 4 years, central banks had been accumulating gold at record rates, documented purchases, publicly reported, hundreds of tons per year, flowing into official reserves. China, Russia, India, Turkey. Nations across the developing world were converting dollar reserves into physical gold. Now that same mentality was extending to silver and industrial metals. Resources were being nationalized, not through seizure, but through strategic classification and export control. And once resources are classified as strategic, they don't get declassified. This wasn't a temporary trade policy. This wasn't a negotiating position that would be reversed after a summit. This was a structural shift in how major powers viewed commodity markets. For decades, the assumption was that global trade would continue expanding, that resources would flow to whoever paid the highest price, that markets would allocate materials efficiently across borders. That assumption was being abandoned. And for precious metals, this created a fundamental problem. The pricing system for gold and silver has been based in Western exchanges since 1975. New York and London set the benchmark prices. Those prices were determined by futures contracts and derivative trading. The actual physical metal was leveraged. Sometimes 100 ounces of paper claims for every ounce of physical metal. This worked, as long as physical metal could move freely across borders, as long as mines in one country could ship to refiners in another, as long as central banks and governments didn't interfere. But now they were interfering, and the leverage was being stress tested. There's a rhythm in markets that most people miss entirely. They see chaos, randomness, unpredictable movements. Craig Hemke saw something different. Since March 2024, when gold broke out to a new all-time high, it had been moving like clockwork. When gold broke out to a new all-time high, it had been moving like clockwork. Not perfectly, not every single day, but over months, a pattern emerged. 20% rally, then consolidation for 2 to 4 months, then another 20% rally. Not wild speculation, not manic buying, a measured, almost mechanical progression upward. In summer 2025, gold was trading around $3,500 per ounce. Hemke did the calculation. 20% higher would take it to $4,200, maybe $4,300. Gold reached $4,200 in October. Actually overshot slightly. Then it consolidated through November and December. Sideways price action. Nervous traders started calling it a top. Analysts were saying the rally was exhausted. This is it, they said. Gold's going back down. But Hemke was watching something else. He was watching the consolidation hold. No collapse back to prior levels, no breakdown of support, just patient accumulation at higher prices. By early January 2026, gold was preparing for its next move. 20% from $4,200 would take it to $5,200. Another consolidation through summer. Then 20% from $5,200. $6,200 per ounce. $6,000 by year end wasn't a wild guess. It was pattern recognition. It was mathematics. applied to observed behavior. But here's where it gets interesting. Silver was following a different timeline, but a parallel structure. Gold had taken 21 months to double from its March 2024 breakout level. Silver finally broke above its old all-time highs in October 2025. If it followed the same doubling pattern as gold, but compressed the timeline, maybe taking half the time instead of 21 months, that would put silver at $100 per ounce by summer 2026. Michael Oliver, another veteran analyst Hemke respected, was even more aggressive. Oliver was projecting $100 by the end of the first quarter. By March, Hemke wasn't willing to go that fast, but he also wasn't dismissing it, because something unusual was happening in how silver was trading. The daily swings had become extraordinary. $3 to $4 moves, routine. Sessions where silver moved 10% barely got noticed anymore. This wasn't normal commodity behavior. Corn doesn't move like this. Wheat doesn't move like this. Even crude oil, in times of geopolitical crisis, rarely shows this kind of volatility. But there was another puzzle. The mining stocks weren't following. Normally, when gold and silver rally, mining company shares rally even harder. They're leveraged to the underlying metal price. When gold goes up 20%, mining stocks should go up 40%, 50%, sometimes more. Operational profits expand dramatically when metal prices rise. Stock prices should reflect that. But the GDX, the major gold miners ETF, was barely higher than it had been in mid-October. Gold had surged, silver had exploded, and mining shares had gone nowhere. Hemke identified the culprit: high-frequency trading algorithms. Studies suggested 80 to 90% of trading volume on the New York Stock Exchange was now automated. Computer programs responding to price signals in microseconds. These algorithms weren't analyzing mine fundamentals. They weren't calculating net present value of ore bodies. They weren't studying reserve reports. They were watching correlations. When COMEX silver futures dropped in the first 2 hours after the New York market opened, the algorithms sold mining stocks automatically, even if silver recovered later in the day, even if the overall trend was up. The machines saw short-term weakness and responded mechanically. This created persistent underperformance in the equity side of the precious metals sector. But it also created something else, opportunity, because eventually, fundamentals override algorithms. Eventually, mining companies reporting record profits get revalued. The lag wouldn't last forever. Then came the commodity index rebalancing story. First week of January 2026. This became a major talking point across financial media. Bloomberg Commodity Index was rebalancing $14 billion in repositioning, $4 billion in gold futures alone. Headlines screamed about massive selling pressure. Financial blogs published articles warning of imminent collapse. Banks sent notes to clients suggesting they should reduce positions. Hemke did the math: $4 billion in gold. Futures equals approximately 10,000 COMEX contracts. The average daily volume in COMEX gold, 150,000 to 200,000 contracts. The rebalancing wasn't happening in one massive block trade. It was spread over 5 days, 2,000 contracts per day. That's 1% to 2% of normal daily volume, completely absorbed by regular market activity. The silver rebalancing was similar, 10,000 contracts spread over 5 days. In a market that trades 100,000 contracts or more on active days, it was noise, not a structural shift. By Thursday, as Hemke was analyzing this, gold had already bounced back into positive territory. The selling that everyone feared, it came and went without impact. But the narrative had created fear, and fear creates volatility. And volatility, in this environment, was masking something far more significant. Because while traders were panicking about a non-event, while algorithms were selling based on 2-hour price movements, while media was generating crisis headlines, the physical metal was still disappearing from vaults. The backwardation was still appearing during stress periods. The supply deficit was still 800 million ounces deep, and governments were still treating silver as a strategic asset. The pattern Hemke saw wasn't about daily chart movements. It wasn't about technical indicators. It was about recognizing that when fundamental forces align, when physical scarcity meets monetary expansion, when government policy reinforces market trends, the mathematics become simple. $6,200 gold wasn't optimism. $120 silver wasn't speculation. They were projections, based on patterns that had held for nearly 2 years, based on structural factors that showed no signs of reversing, and based on something else entirely, something that was about to become impossible to ignore. There's a moment in every major market shift when policy becomes more important than price, when what governments decide matters more than what traders think. Craig Hemke believed that moment had already arrived. The Trump administration had abandoned the narrative, the Doge cost-cutting promises. The talk of $2 trillion in spending reductions, the balanced budget rhetoric, gone, quietly shelved. What replaced it was something far more explicit. Run it hot. That was the phrase Treasury officials were using. Not in private meetings, not in leaked memos, publicly, on camera. Run it hot meant keeping deficit spending above $2 trillion annually. It meant cutting short-term interest rates as much as possible. And it meant, if bond markets pushed back, if long-term rates started rising in resistance to fiscal expansion, implement yield curve control. The Federal Reserve would directly intervene in the bond market to cap long-term rates. This had been discussed openly. Treasury Secretary Bessent had referenced it. Fed governors had mentioned it as a policy tool. It wasn't speculation. It wasn't conspiracy theory. It was the stated backup plan if markets didn't cooperate. For precious metals, this was extraordinarily bullish because it meant one thing. The policy choice had been made. Inflation over deflation, expansion over austerity, monetary creation over fiscal discipline. Every lever of power was being positioned in the same direction. But Friday, the day after Hemke published his analysis, would bring two events that almost no one was connecting. First, the December employment report, the first actual current jobs data since early September. Markets were pricing in a 50-50 chance of a Federal Reserve rate cut in March. This jobs report would shift those probabilities. If employment was weaker than expected, rate cut odds would increase. Lower rates meant weaker dollar, higher gold and silver prices. If employment was stronger, rate cut odds would decrease. But Hemke wasn't particularly worried either way, because the broader monetary policy direction was already locked in. The second event was bigger, the Supreme Court ruling on Trump's tariffs. The tariffs implemented in April 2025 were being challenged on constitutional grounds. The court had heard arguments in November. They were expected to issue rulings Friday morning. Multiple decisions, 10 a.m. Eastern. When those tariffs were first announced in April, silver had crashed, dropped from $36 to $28 in 3 days, an $8, 22% collapse. The market interpreted tariffs as deflationary, as economically contractionary, as dollar positive and commodity negative. Now, the question was whether those tariffs were even legal. If the Supreme Court ruled them unconstitutional, if $250 billion in collected tariffs had to be refunded, where would that money come from? More deficit spending, more bond issuance, or more creative accounting? Which brought the conversation back to something Hemke had been watching closely: gold revaluation. Trump had signed an executive order on February 2nd, 2025, establishing a framework for a sovereign wealth fund. The question then became, how do you fund a sovereign wealth fund without selling bonds? You monetize existing assets. The United States holds approximately 8,000 tons of gold at the official price of $42 to $122 per ounce. Established in 1971, that's worth about $11 billion at current market prices, around $4,000 per ounce. It's worth over $1 trillion. At $10,000 per ounce, it's worth over $2.5 trillion. The difference between the official price and the market price sits on the Federal Reserve's balance sheet as unrealized value. If the Treasury called in those gold certificates, if they revalued the gold to current market prices, the Fed would transfer the difference to the Treasury. No new money printing in the traditional sense, no new bonds issued, just an accounting adjustment. But the result would be over $1 trillion in available capital, capital that could fund a sovereign wealth fund, capital that could purchase Greenland, if that negotiation actually proceeded, capital that could finance infrastructure without increasing reported deficit levels. Bessent had literally said the words on camera: monetize the asset side of the balance sheet. The mechanism was there. The legal framework existed. The question was whether they would actually do it. Hemke's answer: look at Venezuela. Nobody thought they'd actually send Delta Force to extract a foreign president, until they did. January 2026, over 160 aircraft, coordinated military insertion. President Maduro physically removed from Venezuelan territory and transported to the United States. Policy statements were becoming operational reality. Nothing was off the table anymore. And if gold revaluation happened, if the official price moved from $42 to $10,000, what would that do to silver? What would that do to market psychology around precious metals generally? The price targets for 2026 suddenly looked conservative. When Hemke published his 2025 forecast 12 months earlier, he was called reckless. Gold at $3,100. Absurd. It was already at $2,600 and had rallied 27% in 2024. Another 10% was greedy thinking. Silver at high 30s? Delusional. That required a 30% gain with spending cuts promised and the dollar surging. Precious metals were supposed to collapse, not rally. He received emails throughout the year, some calling him a permabull, others suggesting he didn't understand basic economics. Then silver went to $80, gold pushed past $4,300, and the emails changed tone. Now he was being criticized for being too conservative. How could he have only predicted 10% and 30%? Didn't he see this coming? It's a losing game. Predict too high, you're reckless. Predict too low, you're incompetent. Hit it exactly, you got lucky. So when Hemke published $6,200 gold and $120 silver for 2026, he did so knowing the criticism would come regardless. But the methodology wasn't guesswork. Gold's 20% rally pattern had held for nearly 2 years. 4 consecutive moves, each followed by consolidation, each launching from a higher base. If that pattern continued through 2026, and there was no reason to think it wouldn't, $6,200 was simple mathematics. Not optimism, not bearishness, just pattern projection. Silver's path was less certain in timing, but the direction was clear. It had finally broken its decade-long ceiling. It was following gold with a lag. If it completed a doubling cycle similar to gold's 21-month trajectory, but compressed the timeline, $100 by summer was reasonable. $120 by year-end was the next mathematical level. The volatility itself told a story. Markets don't move like this unless something fundamental is breaking. Stable commodities don't swing 3% to 4% daily. They don't require repeated margin increases from exchanges. They don't trade in backwardation for extended periods. These were symptoms of a pricing system under structural stress. And the stress wasn't going to decrease in 2026. Every factor that drove prices higher in 2025 was still present. Supply deficits weren't reversing. You can't add 800 million ounces back to global inventories overnight. Mine production takes years to expand. New deposits take a decade to develop from discovery to first pour. The physical shortage would persist. Government resource nationalism wasn't reversing. Once silver becomes a strategic critical mineral, it doesn't get declassified. Once China implements export controls, those controls become permanent policy. Strategic materials don't return to free market status. Central bank gold buying wasn't reversing. 4 years of documented accumulation, hundreds of tons annually flowing into official reserves. Why would that stop? Why would emerging economies suddenly decide dollars were safer than gold? The geopolitical tensions weren't reversing. Venezuela wasn't an isolated incident. It was a statement of operational capability. Colombia negotiations, Greenland discussions, Panama Canal rhetoric. These weren't campaign talking points. These were active policy initiatives. The monetary policy trajectory wasn't reversing. Deficit spending above $2 trillion annually. Rate cuts on the short end. Yield curve control if necessary on the long end. Running it hot wasn't a slogan. It was the explicit strategy stated by Treasury officials. All of these trends pointed in one direction. Higher prices for monetary metals and strategic commodities. Hemke's 15 years in the market gave him perspective that newer analysts lacked. He'd seen multiple cycles. He'd watched silver spike to $50 twice and collapse both times. He'd lived through the 2011 crash. He'd seen every bearish argument and every bullish fantasy. This time felt different to him, not because of price levels, but because of the underlying structure. The physical market was genuinely tight. Government actions were genuinely restricting supply. Monetary policy was genuinely expansionary. Despite rhetoric about fiscal responsibility, these weren't narratives. These were documented facts with verifiable evidence. The backwardation wasn't a rumor. It showed up in exchange data. The supply deficits weren't speculation. They appeared in industry reports. The central bank buying wasn't a story. It was disclosed in official reserve figures. This was why his 2026 forecast carried conviction. Not because he was bullish by nature, but because the structural factors all pointed the same direction. And unlike 2025, when he was predicting moves that seemed unreasonable, the 2026 targets were simply extensions of established trends. Gold moving from $4,200 to $6,200 was less dramatic than the move from $2,600 to $4,200. Silver moving from $80 to $120 was proportionally smaller than the move from $35 to $80. These weren't moonshot predictions. These were trend continuations. Precious metals were transitioning from speculative assets to strategic necessities. Governments were treating them that way. Central banks were treating them that way. Industrial users were treating them that way. The pricing system was adjusting to reflect that reality. $6,200 gold and $120 silver weren't predictions of mania. They were projections of a market repricing strategic scarcity in an environment where scarcity was being deliberately manufactured by policy. And that repricing, Hemke believed, had only just begun.